Pues vamos a dar comienzo con la conferencia del día de hoy. Quiero agradecer a nombre de la CFA Society México a Colchester que nos vayan a dar esta muy interesante plática sobre este tema tan relevante en la coyuntura actual de la inflación y su modelaje. Quiero agradecer a todos ustedes, miembros de la comunidad CFA y de la comunidad de los mercados financieros que nos acompañen, y espero que encuentren tan interesante esta plática como yo la encuentro, y seguramente así será. Para presentar a nuestros panelistas, pues les cedo la palabra a Analia de Colchester, que nos dirá pues quiénes nos van a dar esta interesante plática. Adelante, Analia, muchísimas gracias por el apoyo.
Muchas gracias, Jaime, y muchas gracias, Guillermina, por tenernos en la tarde de hoy. Es un placer para nosotros estarles presentando nuestro modelo con el que usamos para proyectar la inflación. Un poco a modo de introducción, contarles que mi nombre es Analia Yaquino, soy especialista de producto para Colchester, cubriendo varios países de América Latina, entre ellos México. Estoy basada en Montevideo, Uruguay. Y para los que no nos conocen, Colchester es una gestora británica de renta fija que se dedica exclusivamente a bonos soberanos y divisas. Solamente hacemos deuda gubernamental, pero cubrimos todo el espectro, desde mercados desarrollados, mercados emergentes y bonos ligados a la inflación. Nuestro proceso de inversión es muy, pero muy sencillo, y como parte de ese proceso lo que miramos es el rendimiento real de los bonos y el tipo de cambio real. Y para llegar al rendimiento real de los soberanos, lo que necesitamos es algún tipo de proyección de la inflación que le restamos al rendimiento nominal. Justamente eso es lo que vamos a estar discutiendo el día de hoy con ustedes. Vamos a estarles mostrando el modelo que usamos para proyectar la inflación en un horizonte de 18 a 24 meses, que es nuestro horizonte de proyección, para los distintos emisores soberanos del universo que cubrimos. Y para ello me están acompañando el día de hoy dos de mis colegas del equipo de gestión del Reino Unido, están basados en Londres, Carl Roberts y Jim Lee. Ellos les van a estar contando justamente cómo hacemos para proyectar la inflación para cada uno de estos países, y aparte Carl les va a estar contando cómo aplica eso al caso mexicano. Carl es el Lead Manager para México, y como parte de sus tareas tiene la proyección de la inflación para el caso mexicano, que lleva todos los meses al comité de inversión. Entonces es un placer para mí poder presentarles a los dos en el día de hoy. La presentación que vamos a estar haciendo va a estar disponible en un PDF que le voy a hacer llegar a Guillermina y a Jaime, así que si alguno de ustedes tiene interés después en quedarse con una copia, se pueden contactar con ellos para tener ahí toda la información del día. Nada más, agradecerles y mandarles un saludo desde Montevideo. Espero que disfruten la charla. Jean.
Okay, thank you, Analia, and welcome everyone. Thank you for joining us for our inflation forecasting seminar. So as Analia had already introduced, my name is Jane Lee, and I'm one of the investment officers here in the London office, and I'm joined here by my colleague Carl Roberts. So perhaps to start, I will give a brief outline on what we hope to cover today in this seminar. So firstly, I'm going to give a brief introduction on Colchester's investment process. And really, this is just to highlight why inflation forecasting is so important and central to our investment framework. And then I'll follow by describing or sharing with you all our inflation forecasting framework, along with some examples. And I'll conclude my section with a few comments on the global inflation outlook that we see today. Carl will then share with you all on how we at Colchester analyzes or looks at Mexico and how we look at Mexico within context of our global and emerging market program. So if I may begin. So Colchester is a sovereign-only fixed income manager, so we only invest in government bond markets. And central to our investment philosophy is value investing. And what do we mean by value? We value bond and currencies according to the expected real return adjusted for the soundness of the country's underlying financial balance sheet. So we look at bonds and currency separately. On the bond side, what we're looking at is real yield. The real yield is simply the 10-year nominal yield minus our forecast of inflation. So this is why inflation forecasting is so important to us, because it helps us derive this real yield metric. Now, of course, different countries have different risk profiles. So we also need to factor in the strength of a country's financial balance sheet and also ESG considerations. So for countries that have strong financial balance sheet and good ESG metrics, we will add a premium to the real yield valuation. And conversely, for those countries that have weak balance sheets or weaker ESG factors, we would subtract a discount to the valuation. Now, what we do is we're looking to build a portfolio where we're holding the higher real yielding bond markets. And in terms of currency, we apply a similar process. We're looking at the real exchange rate, or PPP, and assessing whether currencies are over or undervalued by this measure. And I probably won't spend too much time or focus too much on the currency side. And I think I could summarize our process as we're looking to build portfolios of high real yielding bonds and undervalued currencies. And our strategy is very much medium to long term in nature, but we believe if we execute this well, this would generate positive performance. And so whilst the real yield calculation is very simple, I think it benefits from like a illustration example. So here we're comparing the markets between Singapore and the United States. So Singapore is the gray bars and United States the blue bars. And so on the left-hand side of the chart, I've plotted the nominal yield between the two markets. And you can see, that they're not too different. Singapore is offering 1.6% for its 10-year nominal yield, and United States at 1.5%. Now, if we take into consideration our inflation forecast, we have a 1% 18 months annualized forecast for Singapore and 2.8% for United States. So this gives actually a real yield of a positive 0.6% for Singapore and a negative real yield of minus 1.3% for United States. Now, typically at this point, we would then look to adjust this real yield valuation with our assessment of the country's balance sheet factors and ESG factors and so forth. I think for the simplicity of this illustration, I'm going to say that they're both broadly very good credit quality markets. You may not know this about Singapore. It's a much smaller bond market, but Singapore is a AAA rated country. Up until the recent period, Singapore has typically run fiscal surpluses, and also it has zero net debt. So those two markets are quite comparable in terms of quality. So this real yield valuation feeds directly into our portfolio construction process. And given that Singapore does offer that higher, more attractive, positive real yield, our construction process would favor the market of Singapore over US. And this is in fact how we're positioned in our global bond program. So I hope this highlights to you why inflation forecasting is so important, because it is the key input in our calculation of this real yield, which is the basic valuation on which we compare different bond markets. And so in terms of our inflation forecasting model, Colchester is quite old-fashioned, and we're monetarists at heart, meaning that we believe that money matters. And so simply put, if a country prints too much money, all else being equal, the country is likely to generate inflation. So we have a proprietary inflation forecasting model, and the main factors in this model are listed here. So clearly, money supply and credit growth is the main input and the most important factor in determining our inflation forecast. And I will go into this each of these factors in more detail when I work through the country examples. So here I'll just give a brief overview. In addition to money supply and credit growth, we also take into consideration more direct price inputs. So for example, we'll look at commodity prices, and I think the relevance of this is very clear. As we've seen this year, the higher food and energy prices have definitely contributed to the upward inflationary pressures that we've seen across many countries. We'll also look at the pass-through effects from changes in the nominal exchange rate. So here, the more open an economy is, either directly through trade or indirectly through imports, the greater the potential for inflationary pass-through effects. And lastly, we'll also look at capacity utilization terms. So here we're saying that countries that are running above or close to the long run productive capacity typically will experience inflationary pressures when faced with excess demand. So here we're trying to determine how much slack there is in the economy, and the sort of terms we'll use include output gaps or unemployment rates. So before I showcase an example of our model, I want to highlight a few more points about our inflation forecasting framework. So our forecast period is 18 to 20 months forward, so the average inflation rate over the next 18 to 24 months. Longer term forecasting is, to our minds, less accurate and also can be subject to political events. So we feel the 18 to 24 month period strikes a really good balance between usefulness and accuracy. And whilst it's important for us to accurately forecast inflation in absolute terms, what is equally as important is the relative inflation differentials between countries, because it is ultimately this relative differential that drives the country selection when we go to build our bond portfolios. And so forecasts are produced at the same time with the same determinants to ensure consistency. And here is an example of our inflation forecasting workbench. And here is we've got a regression model, regressing CPI against lagged money supply. So I'd like to highlight a few things here. You can see on the upper left-hand side, we're using different lag periods. So academic research, for example, suggests that there often is a 1 to 2 year lag between money supply and inflation. So we also model different lag periods in our forecasting model. And we also incorporate different time periods, which is at the bottom. And this is where the qualitative assessment comes in, as different periods may be more relevant than others for certain countries. So ultimately, what we're looking to produce is a profile of potential inflation paths. And you can see that in the blue fan chart. So this quantitative model is the basis or the starting point of our forecast work. But there is also a qualitative aspect which I will go on to illustrate. And I just want to highlight that this is just one example of a single factor model. We run also other single factor models or multi-factor models to take into account other factors such as commodity prices or FX pass-through effects. So I'll move on now to illustrate with the example of Poland. So here you can see inflation is marked by the blue line, and we've used M2 as our measure of money supply, and we've lagged this by 3 years. So we think, this is a fairly good fit. And I want to, so what I find interesting to highlight to you is the period leading up to the beginning of 2019. So in the aftermath of the European debt crisis, which sort of ended around 2012, you can see this fall in inflation. That also coincided with an oil price shock. But at the beginning of 2015, inflation started to pick up, and then it sort of dropped at the beginning of 2019, where you see that it fell below 1%. But our model was showing at the time that actually money supply has almost doubled. It's moved from below 5% in 2015, in the time period marked by 2015, to over 10%, doubling over that time period. So our model was suggesting to us that actually inflation, we should be expecting a pickup in inflation. And if we move on to the next chart, we're seeing similar signals from the other indicators as well. So around the same period, we see that unemployment rate has fallen or trended sharply lower. At the same time as capacity utilization picking up, which makes sense because actually the economy was growing quite robustly at the time. It was average around 4 to 5% GDP growth annually. So capacity terms or capacity utilization and the sharp fall in unemployment were giving us the same signal as that from the money supply. If we move on to exchange rate, here we're not really seeing such the same signal. The euro to zloty was actually quite relatively stable over that period. And if we move on to commodities, again, we do not see such a strong signal here. But there is a particular point I think that relates to Poland in that a lot of the pricing is government related. So changes in energy prices and such, the pass-through effect is not so direct to households or to CPI numbers due to the government regulated pricing. So going into 2019, our inflation forecast for Poland was at 2%, but our regression model or the indicators that I've outlined here was actually pointing to a higher level of inflation going forward. And what is also interesting is that, we supplement this with some qualitative assessment. So what really stood out to us at the time was the tightness in the labor market. So in the years leading up to that, the EU had announced that Ukrainians had so prior to this, there were a lot of Ukrainian workers in Poland. And around this, in 2017, EU had announced that Ukrainians had the right to work in other EU member states. So Poland saw a very strong net outbound of migration of Ukrainian workers. And not only that, it's been so well observed that hundreds of thousands of Polish workers themselves have also left to go to other EU member states. So the labor market was exceptionally tight, and this really drove wage growth. And we saw that as a qualitative factor that also confirmed our quantitative work. And consequently, we had moved our inflation forecast to the 3% level. And of course, a key question is this, whether Colchester is any good at inflation forecasting. And here, I would like to suggest that we have quite a good track record. So we've compared our inflation forecast to that of the OECD's, who do very similar inflation forecast work as we do. And this chart shows the forecasting error. So a downward pointing bar shows that our own Colchester's inflation forecast has a lower forecasting error, and an upward bar shows that OECD had a lower forecasting error. And as you can see on this chart, for the majority of the countries, we've done a pretty good job at inflation forecasting. So I wanted to end my section with a few comments on the global the global outlook on inflation. Clearly, the increased inflation that we've seen both in developed and emerging market economies has been very topical and focus of financial markets this year. And we think much of this inflationary pressures is due to the reopening of the economy after the COVID shock, and especially against a backdrop of very strong monetary and fiscal stimulus. So the release of pent-up consumer demand as well as accumulated savings is also facing challenges of supply chain disruptions, labor shortages, rising commodity prices, and changes in consumption patterns. So we suggest that the economy has undergone a rapid change in a relatively short period of time. So of course it stands to reason that all this will take some time to adjust. So we are sympathetic to the view that a number of these factors are transitory, but we also think that many of these factors are now looking likely to persist somewhat longer than we had initially thought. And we think it's also reasonable to expect some structural shifts to take place in response to the pandemic. So for example, we can see that corporates may look to enhance supply chain resilience and move production back onshore. We have observed that there's increasing sense of nationalism with some countries, for example, like China. So governments also adopting, great spending stimulus programs, and even things like the ESG-related initiatives aiming to reduce carbon emissions is possibly going to result in higher cost structures going forward. So we think there is still a high degree of uncertainty, but we also want to emphasize that there is also a lot of divergence. So if we move on to the next slide, in 2020, going back to one of our key inputs, money supply growth, in 2020, nearly all the countries experienced an increase in money supply growth as policymakers provided stimulus to support their economy. Money supply growth that we've seen this year has now falling back to more normal levels. However, there are still some countries running at elevated levels compared to pre-pandemic norms. And a really good example of this is the United States. In a decade leading up to the end of 2019, the M2 money supply growth averaged just under 6%, and it rose to a peak of 27% beginning of this year before subsequently falling back. However, it now seems to be settling in around the 13% range, which is more than twice the pre-pandemic average. So perhaps it's too early to say, but it does suggest to us that there is a risk of high future inflation. And if we move on to looking at actual core CPI numbers, again, we see this similar pattern of divergence. And if I just pick the world's two largest economy here, United States and China, you can see, like, for example, in China, at the start of the year, inflation was just not much more above zero and even dipped into negative territory, but now has settled just above 1%. Whilst for the US, at the beginning of the year, it stood at 1.6%, and it has increased quite markedly to over 4%, and it's now settling around the 4% level. So it is, and similar picture across emerging markets. So it is clear to us that there are definitely different inflation dynamics at play. And also, given the uniqueness of the current recovery phase, we think this all makes for a very interesting study and makes it all the more important our work on inflation forecasting. And I will conclude here and hand it to Carl.
Thanks, Jean. Right, I am going to run through our outlook kind of on Mexico, but probably more relevant since I'm speaking to a group of Mexicans. I'm not going to tell you anything that you don't know about your own country, but I think what's more important to try and showcase is how we go about really comparing Mexico to the rest of the world. Mexico is quite a unique country for us in that it features both in our global bond opportunity set, as well as, of course, the EM local opportunity set. So just a bit of history. Obviously, debt levels in Mexico had declined actually coming into the pandemic. So by the end of 2019, gross government debt stood at around about 53%. As the pandemic occurred and 2020 moved on, the fiscal response from Mexico was obviously relatively muted compared to a lot of other governments around the world. So breaking it down, as you can see there, around about 1.2% of GDP in terms of a fiscal response. This was obviously, smaller compared to not just some emerging market pairs, take Brazil, for example, but even the likes of the UK, many Eurozone countries, and of course the US. Now, from a bond investor's point of view, sort of fiscal prudence and these kinds of things, maintaining fiscal discipline, it was obviously something that is actually very attractive for us. Yes, one can argue there can be growth implications down the line, but that's arguably a separate argument and point to make. So really, coming out of the COVID pandemic, debt to GDP at 60% is not really too bad, certainly when you compare that to peers. So what I will do is broadly walk you through the different ways we sort of analyze Mexico, I guess, if you like. Jean talked about how we go about inflation forecasting. I will definitely touch on that for Mexico. But to start with, I think if we go through really how we assess Mexico's balance sheet, that's both on the government side, the external side when it comes to comparing currency valuations and fundamentals, as well as ESG factors. We integrate those into our holistic analysis of a country. And then lastly, I'll conclude with inflation. So just looking at government debt, really what we're trying to do is obviously compare Mexico to peers. And like I said, this is both on the EM and developed market side. And one way we can look at possible debt dynamics over the sort of medium term is just sort of looking at nominal yields in a country minus nominal GDP growth, as just to give us a kind of a yardstick measure for sort of how governments need to react in order just to keep debt to GDP levels stable. Now you can play around with sort of length of time that you look at sort of growth over or yields over, but for this case we've just looked at the last 3 years of Mexican yields and Mexican nominal GDP growth, well, for yields and growth for all countries. So you can see Mexico there on the far right in red. So this analysis would show us that Mexico needs to run a primary balance surplus just to maintain debt to GDP at around about that 60% level. Now, if we compare that to what the IMF is forecasting for the end of 2024, you can see they're only running around about a 0.5% fiscal surplus. So short of this kind of yardstick. However, the fact that they are running or forecast to run a fiscal surplus, for us is a big positive. If you compare that to a country, say like Thailand, which needs to run a primary surplus just to keep its debt stable. However, as you can see there, it is actually forecast to run a fiscal deficit. So looking forward, at least on the debt side, Mexican debt, whilst it is likely to continue trending somewhat higher, it should do at a very muted pace, provided the government, retains really one of its key anchors over the last few years, and that has been its degree of fiscal prudence. On the external side, what we look at here is really what we sort of term external vulnerability. So what we do is we take the current account and we add back in net FDI, so those long-term foreign direct investments back into economy. What we then see is those countries that have a positive balance have much less issues around external vulnerability, whereas those countries that have a sort of a negative balance, they require additional inflows really to balance their balance of payments. So, this typically for your standard emerging market would be things like portfolio inflows, which, as we all know, tend to be, relatively flighty in times of market stress. And, they obviously add to pressures on the external side. So when we look at Mexico in this context, it has a positive balance. And, it rates relatively well to many of its emerging market peers. On top of the fact that it has this positive balance, we know FX reserves are at about 17% of GDP. and thinking about government external borrowing, that's around 20% of the debt stock. Now, if you compare that to, say, a similar country like Indonesia, which is 2 down from Mexico on the right, you actually have quite a different story. FX reserves in Indonesia are only around 11%, and its proportion of government debt that's in foreign currency is actually more towards 40%. Or if you take a country like South Africa, ZAF, which is towards the left, it certainly has a much higher positive balance than Mexico does. However, it has reserves that are sort of on par with Mexico, but does have slightly lower foreign currency government borrowings at around about 13%. So overall, Mexico ranks quite favorably again on the external side. Turning to ESG, as sovereign-only investment managers, governance for governments, as we like to say, is one of the important factors with regards to sort of the topic of ESG for us. And when we look to that, just using the World Bank's worldwide governance indicators, you can see I've highlighted Mexico in red there. Zooming in or sort of bigger picture, obviously we all know there's a strong link between levels of governance and GDP per capita. What we try and do is sort of normalize some of this. So we're not just simply looking at countries and effectively scoring or rewarding higher income countries relative to lower income countries. And so that's what we've got on this chart. So you can see I've zoomed in to where Mexico lies and looked at countries with a fairly broadly similar level of GDP per capita. So Mexico unfortunately does rank sort of below the average governance score. The likes of Turkey, Kazakhstan, Serbia, again, they have similar levels of GDP per capita, all rank slightly better than that. Mexico really suffers from poor control of corruption, as well as weakness around rules of law. So overall, it does place it in the bottom 10th percentile of our overall sort of governance ranking, again, when we compare Mexico to the broader universe. So on the social side, Mexico does suffer from sort of relatively higher income inequality, again, relative to peers, and it does have a low ranking on the Human Development Index. However, when we look towards levels or standards of education, and for this we look at PISA scores, standardized tests that are done in most countries around the world, Mexico's doesn't fare too badly, certainly relative to GDP per capita. And when we think of how this then impacts the economy over the medium term, sort of education standards, quality of education, that feeds into things like productivity or GDP per hour worked. And Mexico on those sorts of metrics, admittedly, is a bit below where it should be. And this is something that can potentially hold the country back. And obviously for us, when we're looking at it on a holistic basis, it can have some negatives against a very strong balance sheet and external position. Lastly, just on the environment, there are some weaknesses again around transition risk. So obviously, as the world moves towards sort of low or zero carbon over the next several decades, really it's on governments to put policies in place, or even pick up the tab, if you like, in terms of transitioning to that lower or zero carbon world. So just looking at the percent of electricity generation in Mexico that comes from renewable resources, at the moment it's just over 20% of total generation capacity. The majority of which, the majority of the remainder of which obviously comes from things like natural gas, which again is sort of a stepping stone towards sort of a cleaner fuel. So obviously that's not too bad if you compare Mexico, say, to a country like South Africa down on the far right. You know, about 90% of South Africa's electricity is actually generated from coal-fired electricity plants. So obviously they have much greater risk and potential cost as the government obviously has to, you know, reskill an entire workforce as the transition to that sort of renewable, lower carbon sources occurs. Whereas Mexico, you know, has relatively less risk around that. Yes, you know, one could argue more solar, more hydroelectric, these sorts of things could come into play for the economy. But given that sort of large chunk of generation from natural gas, the country is at least well on its way towards meeting those targets. Right, so turning to inflation outlook for Mexico. So I've just got one slide up here, you know, a bit like what Jean showed you earlier with Poland. And really it's looking at, you know, the sort of principal thing that we look at, money supply versus inflation in blue. So obviously, you know, there was the deceleration in inflation during the pandemic, like most countries experienced, you can see there. But we have had that uptick in money supply, which you would have seen on Jean's chart earlier. And undoubtedly, that's been partly, you know, responsible for this surge in inflation that we're currently seeing in Mexico. So at the moment, 5% on a 2-year annualized basis, which is sort of our preferred measure. Now, looking forward, because that's what we're trying to do, money supply, as you can see there, has actually very quickly moderated out in Mexico. In fact, on a year-on-year basis, if I was to show you that chart, money supply growth in Mexico is about the lowest it's been for about the last 10 years or so. So from a money supply perspective, we don't really see much impetus coming from there. If you contrast that to a country like the US that Jean highlighted, which is running money supply growth levels much above where that was pre-pandemic. So from a money supply perspective, you know, we're fairly comfortable that there's not going to be any, you know, sort of excess liquidity in the system driving inflation. If we think about some of the other factors that we look at, things like the currency, obviously the Mexican peso, you know, if you think about it in sort of a rate of change perspective over the last 12 months or so, that's actually sort of strengthened broadly. So there's no inflation impetus there. You know, one could argue there's sort of some sort of disinflationary element coming from there. Obviously, the currency, you know, and pass through, generally speaking, in Mexico is relatively low, certainly compared to some of its emerging market peers. So, you know, it's on the order of below sort of 10% pass through. You know, there's different dynamics that can be at play, but certainly it's below 10% now. Compare that to a country like Turkey, where the pass through from any FX depreciation begins at 17% and can easily go over 20% depending on how fast the depreciation is going and what sort of level of spot the currency can be at. So again, no issues with sort of currency. Clearly on the commodity side, things like oil and food prices, they've obviously been very high recently. That will be feeding into some inflationary pressure going forward. But certainly from what we can see, those impacts are likely to drop out over the next 6 to 12 months. So therefore you get the benefit, so to speak, of those base effects as those higher prices drop out over that time period. And again, thinking about our 18 to 24 month forecast, you know, we believe that sort of inflation from here should be sort of rolling over. So actually that leaves us with the current forecast for Mexico at 3.9%. So that's 3.9% on sort of a 2-year annualized basis at the moment. So really, you know, things we think in Mexico should obviously sort of, you know, roll over on the inflation front. So just to kind of wrap it all up, you know, we do think that Mexico obviously has very strong institutions with regards to the central bank, very credible sort of fiscal prudence that it's run Certainly even in the current administration, but previous administrations too. It does have a credible inflation targeting regime. There are obviously, weaknesses on the ESG side, which for us, sort of knock off the positive impact slightly that we see both on the balance sheet and external side. So just to give you an idea of where Mexico sits for us, we have, when we look at countries within our financial stability score framework, combining both the balance sheet and ESG, we give any country a score between a +4 and a -4. For us, Mexico sits at a -1. So again, those strong balance sheet or relatively strong balance sheet metrics are just nudged down by that sort of weak governance and some of those social factors. Now, obviously, putting this all together when it comes time for us to build the portfolio, I've spoken to you about the inflation forecast. You can look at what nominal yields are in Mexico at the moment. Obviously, that puts Mexico in a very favorable position with regards to its real yields. And keep in mind, again, Mexico is both in our global bond and EM opportunity set. And for both sets, it ranks amongst the top 5 highest real yielding markets for us. So you won't be surprised to find that we're overweight in both programs. Now, obviously, that real yield that we give it, or that it works out to be, is reduced slightly by that -1 score before we then rank each country's real yield relative to its own market volatility. Again, when we're building the portfolio, we're thinking about tracking error volatility. So these different factors start to come into play. When it comes to comparing Mexico to its global bond peers, actually it's relatively lowly correlated, only 0.3, on average, and that's markets from the likes of the US, UK, but down to Indonesia, Australia, and New Zealand that we include in our set. And obviously that puts Mexican bond market volatility slightly above global peers, but it is for example below where UK gilt volatility is. So Mexican bond volatility is the order of 5-6%. UK sits at about 6.5 to 7%, for example. In the EM local side, Mexican bonds are actually, below average volatility. So if you can imagine the broad range, Brazil, South Africa, Turkey, etc. So again, that actually works in Mexico's favor, And again, correlations across the sort of EM universe are low at just below 0.4. So again, just helping make the Mexican case within a portfolio context that little bit more attractive. And that is it.
Thank you, Carl. I think we have a couple of questions in the chat, and if Guillermina and Jaime are okay, we can sort of open the floor to those.
Yes, of course.
Thank you.
So I have a question in the chat for you guys. So it is really asking us whether the model includes other variables and how do we calculate stagflation? That's a question.
Okay. You want to take that one, Jean? Or?
Yeah. So as I mentioned, for our model, our main input is money supply and credit growth, and then we have the additional sort of terms that I've outlined: FX, pass-through, commodity, capacity utilization, which encompasses itself quite a number of different measurements like output gaps, unemployment. So these are the main things we look at and run regressions on, partly because there's accessible data and it's measurable. So anything beyond that often is a qualitative assessment. So the forecasting model is the quantitative basis, the starting point, which gives us a sense of direction. And then obviously, not obviously, but every country research analyst, so Carl and I both have country research responsibilities. We make an in-depth study on the country that's responsible, like the way, Carl has walked you through his country analysis on Mexico. So then there's a lot of qualitative factors that also feed into, maybe not in a defined way, but like that also informs us on our inflation forecasting. So in terms of stagflation, now that's a phenomenon where inflation is very high and unemployment is very high. So I think, our model and our inflation forecast will obviously solve the first component, like we will tell us or give us, or our forecast will give us an indication of whether we think in a particular market, whether inflation is going to be very high now. And as Carl had just highlighted, Mexico, we don't really see that risk. So I hope that answers your question, because so it won't really give out scenarios as such. That isn't really the purpose of our inflation forecasting model. The inflation forecasting model, the output is all the different potential inflation paths that is possible or that is indicated by the input factors.
Okay. Okay, we have another question. So someone is thanking us, and they're asking us if the variables and the level of the parameters of this model have stayed constant throughout time, or are they being constantly updated? And how stable has it been, and for how long has the model been used?
Yeah, sure, I can take that one. Yeah, no, that's a really good question. So just to answer the last part first, perhaps. So the inflation model and framework has been in place since Colchester first began, so back in 2000. However, our CIO and co-founder Ian Sims has actually used this for, I think, pretty much almost his 40-year career. So this framework, largely based on money supply, has a long and steeped history. So it has been used and tested in many different economic cycles over many decades. So fundamentally, nothing has changed with regards to the model and the inputs, as Jean described. In terms of sort of variables and these kinds of things, we're very cognizant that economies obviously do change over time, and the relationship between the impact of money supply to inflation varies. If you just take most of the sort of global inflation over the last 2 decades, we've obviously been in a broadly sort of disinflationary environment. You can put that down to sort of globalization, tech, all these sorts of things. There are obviously qualitative factors that can't necessarily be plugged into a model. So we're not fixing coefficients, rather we're trying to tease out relationships. And as Jean alluded to, we're running different lag periods, we're running different time frames. Maybe we need to exclude a time period because there was a sharp currency depreciation that's obviously not going to be repeated. So those things, we're running the sort of model every quarter. We're getting these updated inflation forecasts, and obviously I like to think of it as sort of adapting to economies over time. Doesn't diminish the importance of any of those factors, but we're cognizant that different economies as well are on different paths with regards to financialization and these sorts of things.
Carl, we have another question which is very interesting. So it says, amongst some of the fundamental indicators that you use, some are published with a significant lag. How does the model deal with those lags?
Yeah, I guess I sort of perhaps touched on it in that last question. So, the thing that we're cognizant of, and I guess this goes probably back to Milton Friedman and stuff, is that a change in money supply impacts inflation with a long and variable lag. So we know that it's not just a simple case of a very linear relationship. Jean did mention it earlier. Let's call it about an 18-month impact from a rise in money supply to impacting inflation. However, and this is why we have those different factors in the model, we know it's just not money supply that will impact inflation. You know, that's obviously not how economies are built. So, you know, by running various lags, what we're trying to do is sort of tease out the underlying impact to inflation from money supply. I think that's, you know, that's one thing that is perhaps different the way we do things compared to, say, you know, standard forecast where you might be forecasting, you know, for a specific time period. You know, we have that rolling window as we move through time of 18 to 24 months. And really it's what's going on at the underlying structural level of inflation in that economy. And when it comes to that, different lags are going to, you know, I would say appear or impact inflation at different times, you know, over sort of a global economic cycle, let's say.
Yeah. Well, I think that that's the whole, you know, lot of questions that we have via the chat. So I thank everyone. Thank you again, Guillermina and Jaime. It's been a pleasure, really. We will make, as I said, the presentation available to the CFA Society in Mexico. So if you want a copy, you can request it to them directly. And, you know, we thank you very much for your time this afternoon. Buenas tardes.
Thank you all.
Thank you.
Thank you, Carl, Jean,
Thank you.
Analia. Thank you, everyone.
Bye-bye.
Thank you. Gracias. Hasta luego. Bye.
Gracias. Hasta luego.
Hasta luego.